Okay, thank you everyone for participating. Welcome to our financial literacy series, volume 1. My name is Jillian Cicchetti, and I am a general surgeon at St. Joseph Hospital in Denver. And I have been working with Robert and Paula Gray for the last couple of years on educating our residents about financial basics. This has been really important to me and on my heart because of my experience the first few years out of residency and how difficult the realization was that I had really no clue about financial basics. So we wanted to put together a series of lectures for you to get you basically get a leg up and be ready to go when you graduate. We're going to start with some introductions. We'll let Rob and Paula go first.
Dr. Cicchetti, thanks very much for the privilege of spending this time with you and your residents. A little background on me is in the late 80s, I started a wealth management business. It was a fee-only wealth management business, which was not really the tradition. People thought I was crazy, but I'd become discouraged by the more traditional model of giving financial advice and being compensated based on commissions. I felt that there were a lot of ethical and conflict of interest kinds of issues that came up, and there was a demand for objective, independent financial advice about money. And so that's what happened in the late 80s. In January of 2016, we sold that wealth management business to a Barron's top 100 registered investment advisor that oversees over $27 billion of assets at this time. And now we just dedicate our time to financial education and financial literacy.
In my job through all of this, I was the CFO of the business, also of our personal life. So I've been in charge of our wealth management, personally and business. I watch all the income and expenses, and I'm the saver in the family.
Rob is the opposite, if I recall.
Okay, don't beat me up, ladies.
All right. Well, thanks, you guys. I really appreciate your time. I've learned so much from you, not only about basics, but also about, the psychology of spending and saving and how, two different spouses in a relationship can contribute to that differently. I'll just do a little more background about myself. I was raised in Colorado. I attended medical school in New York City, and I came back to Denver to do my residency here at St. Joe's. And I was out on my own after residency for 7 years in private practice. And I quickly learned how much I had to learn, and Rob and Paula were a big part of my education. I also have several entrepreneurial side gigs, so that gives me a little bit different perspective as well. So I am married and have 2 children and a cute little puppy dog, and try to keep the balance going. Let's jump right in, okay? I really want to get this point across to you because I'm sure you're thinking, Dr. Cicchetti, with all the things I have going on as a resident, I'm just learning how to be a doctor. Why should I care about financial literacy? I don't even make any money right now. Why should I care? And there's a couple different reasons. The first thing I really want to clue you in on is that there's this sort of financial game. I'm going to call it a game. And you have everything it takes to win the game. The fact that you're sitting here listening to this lecture means that you are either in medical school or residency. You are aiming, you'll be out making quite a good income shortly, and you have all the skills that it takes to win this game. But they never taught us the rules of this game in medical school. I mean, I don't know of anyone who had financial classes in medical school. And most residents, when I talk to them, don't even know what I mean when I say win the game. They guess things like, you want me to be able to retire? And I say, no, better than that. You want me to be able to be happy? Yes, but that's just one part of it. No, what I want for you is what's called financial independence. And what that means is that you get to make the rules for your life. It takes away stress. It allows you to completely burn disillusionment and burnout because you have other plans and other abilities to pivot when you need to. It allows you to work because you love it, which is what we all got into this to begin with, not because you need to pay your bills. And it gives you the headspace, if you want, to create alternative streams of income so that even if you cannot work as a physician anymore, you can continue to live the life that you're building. So your second job while in residency, as if you needed one, is to learn basic financial literacy skills. Another reason this is important is to avoid being taken advantage of. There are plenty of people out there who see rich doctors and are ready to charge you lots of money to do things that you can do for yourself. And you can't win this game if you don't even know the rules. So we are here to teach them to you. One of the first things we want to talk about is the fact that you need to hire professionals to teach you, not just do it for you. So there is a term in the financial services industry, it's probably in other industries as well, called a Henry. And everyone in this room will, if they're not now, will very shortly be what's termed a Henry. And that means high earner, not rich yet. And so these are just a few of the little clips that I pulled off the internet that this is definitely a term. And so this is what you are, and you need to learn what to do with this so that you don't end up broke like Henry here in the second picture. Henry's broke, don't be like Henry. So
Dr. Cicchetti, let me interrupt there for a minute, because this is, I think, such a key point that you're making. The financial services industry is really counting on doctors to use the financial services system as what I would describe as financial daycare. So they recognize that doctors don't have good money parenting skills. So they want you to just drop your money off, don't ask a lot of questions, check back with us in 90 days and see if you like the way that your children, money, are behaving. And if you don't, we'll just try to find some other things that we can sell you that will work better. So avoiding financial daycare is what this is all about.
Yeah, and at least making you smart enough to realize when a deal is not a good deal or you're being taken advantage of, for sure.
Exactly.
Okay, 2 take-home points here. You cannot be 100% clinical and also be financially successful at the same time. You have to make headspace for these concepts. And secondly, being financially successful allows you to work on your terms, which is not something that we ever really feel like we have in medicine these days. But if you are financially sound enough to walk away, or at least have money in the bank to give you, 6 months to find another job, then you're not beholden to a bad situation. And that's what a lot of physicians feel like when they're stuck in a place they're not happy. This chart, we're going to show you quite a bit during this series of talks. This is sort of your checklist of what we expect you to be working on in order to become financially successful. So physician financial priorities. This box here, this red box, shows us the things that we think you should be able to do during residency, and the other ones are things that will probably happen after residency, but we'll quickly go through these. So disability insurance, protect your investment. If something happens to you next year and you get into a terrible car accident and you can no longer be a doctor, are you and your dependents taken care of in that situation? And that's exactly what disability insurance is for. Number 2, life insurance and a will. Protect your dependents. Again, if something happens to you and you die, are your dependents taken care of? Number 3, an emergency fund. As a resident, you should have, $2,500 or so in a bank account. It's a savings account. This is for things like the water heater breaking, your car needing repairs, a last minute unexpected trip to see a sick loved one, anything like that. As an attending, we expect you to have 6 months of living expenses set aside. Again, this is for something like I unexpectedly lost my job for some reason and it's going to take 3 months to find one. Having that amount of money set aside allows you to be very clear-minded. You don't have to worry. You have a backup plan. Number 4, get your employer matched contributions. So if you're at an institution with a 401k or a 403b, this is free money and you should not pass up free money ever. So take full advantage of that. We will talk about this in later seminars. Number 5, work on your financial literacy. So again, we're going to give you some resources, but even if you spend an hour a month during residency paying attention to this, you'll be way far ahead of the game than most other physicians by the time you get out. Once you have finished residency, we have another list of tasks for you. The first one is to refinance your private loans and refinance your direct loans to get the best interest rates that you can. Pay off any high interest debt like credit cards, then low interest debt like your student loans, and then saving up a house down payment and learning how to invest. So this is the order of the priorities as we see it. If you work those steps 1 through 11, you'll be set up really well. And we're going to show you a lot of the how-tos on all of these things as we go along. All right, today's agenda. Financial literacy, what you need to know. We're going to go through a lot of basics. We're going to talk a little bit about student loan management. We're going to talk about the fact that accumulation of wealth is a learnable skill, that if you never work on it, you will not have that skill. We are going to go through a couple of common mistakes that doctors admit to making, but that may be a little later. You guys, we need to cut this. I can edit this out. I'm sorry, I didn't take all this stuff out. What do you want me to take out? This one.
Not doing the common mistakes doctors make in this one.
Yeah.
Uh,
And take out the who to trust.
Okay.
That's it.
The rest is fine.
well, we don't do a lot on pay off debt or invest.
Yeah, no, we do. There's a slide on that.
All right.
That's all you needed to do, Jillian.
Okay. All right. Let me just go back to here. I knew we'd have a couple of snafus, so.
No biggie.
Okay. All right, today's agenda, what are we going to cover? Financial literacy, basics of what you really need to know to be a savvy physician. Some information about student loan management, what are your options? The fact that accumulation of wealth is a learnable skill and one that if you pay no attention to, you will end up at the end without that skill. Some resources to start your journey to financial independence. There's a lot of really great resources that Rob and Paula are going to cover that are available free of charge to you as a resident. And then financial priorities, we went through the priority checklist, but also when you get to that end, should I take this extra money and pay off debt or should I invest it? And we'll go through how you make that decision. I want to talk a little bit about the secrets to physician wealth. And sometimes people cringe when they hear this part because you guys have all been sort of delaying gratification for a long time. And part of what I'm going to ask you to do is to continue to do that, even into the first couple of years of being an attending. But here's the kind of step-by-step instructions on how to attain physician wealth. So first of all, make a lot of money. Okay, that's a done deal. I don't care even if you work for a not-for-profit healthcare system or a charity clinic, almost all physicians are going to make 6 figures. Many of them will make many times over that. And so you will have somewhere between $3 and $10 million go through your hands in the next 30 years of your career. And anyone is able to make a pretty good living and accumulate wealth with that sort of income. So you're kind of already in that boat. But number 2 is much harder. Don't spend all of your money. And this is a very hard discipline to get into, especially when you've been living, your college years for 10 years, right? You always feel like you're living off of loans and scrimping and saving. But you really have to realize that if you can master this skill, this is probably the one thing that trips people up the most is, well, now that I have all this money, I'm going to buy a fancy car and buy a big house. So make a lot of money, but don't spend all of it. 3, learn how to make your money work as hard as you do. You've made a lot of sacrifices to make this investment in your future. And if you keep some of that money back, we'll teach you how to make it work hard for you to keep making money for you, even when you're off enjoying or sleeping or doing other things. Try to avoid losing money in very avoidable ways. So things like high interest rates, taxes, disability, divorce is a big one of these. We can get people really set up great and then they go through a divorce and it's like they're starting over all again. Speculation, meaning bad investments, things that really are too good to be true and you should know better, those sorts of things. So again, to recap, you've already won this game because you're sitting in this virtual room and the rest is simply discipline. And you guys are all very good at discipline. So let's go back through these steps on how to create high net worth out of high income, which are 2 very different things. Okay, we kind of went through this, but continuing on with the same theme, live like a resident while you're in training. I recently had a graduate about 3 years ago who was just leaving to go to his first new job. And he said, Dr. Cicchetti, I have a question. I just sold my house, and in 5 years, I made $100,000 on my house. And I'm trying to decide what to do with my $100,000. Should I pay off my car, or should I pay off my credit card? And I said, well, what are your interest rates on both? And then I said, and how much do you have on your credit card? And he says, $100,000. And I think I just about spit my coffee across the room, because no resident should end up with $100,000 in credit card debt. I mean, student debt is one thing, but credit card debt was basically just racked up because he was living like an attending before he was an attending. And he literally said to me, well, I only made this much money and I needed $2,000 extra every month to live the way I wanted to live. So I just put it on a credit card. That is not going to get you very far. Luckily, his house appreciated enough that he did pay it all off. But not every resident makes 6 figures on their house while they're in training. So let's not count on that. Secondly, if you can keep that discipline going for 2 to 3 years after you're done with residency and continue to live that way, and in fact, I'll even give you the ability to give yourself a 100% raise. So if you're making $60,000 during residency, give yourself a raise up to $120,000 and continue to live under that amount of money and put all of the rest of it towards paying off your debt. If you can continue to live that way for a few more years, you'll be able to carve out a massive chunk of your income with which to build wealth. And you do that by following this physician financial priorities chart, which I put back up here again. We're going to provide that document to you as a PDF download so that you can keep that handy, either electronically or on paper format. Once you've been able to do these things, then you really can sit back and enjoy that good life. After 2 to 5 years, what you've envisioned as the life of an attending, you will actually have achieved. I want to go through a short calculation to go through what these numbers might look like. So as a resident, we'll say the average resident salary is $60,000. The average attending salary is $275,000. Now this may vary if you're a primary care or pediatrics or things like that. I'm going to go with averages. So we take $85,000 off the top for taxes. We take that $60,000 with living expenses, and that leaves behind $130,000 every single year that you can use to build wealth. And that means pay off loans, save up your down payments, max out your retirement accounts, and look what this does for you. If you have $130,000 a year to throw against your student loans, even those of you who are graduating with massive amounts of debt at 400, or even had a resident recently who graduated with $500,000 in debt, that takes 3 or 4 years and it's gone. It's totally gone, and you can move on and, get all of that behind you. Most physicians are spending 20 years to pay their debt off, and you can do it very quickly if you can just continue to live that way for a few more years. We'll go back through this chart a couple times during this series. I just wanted to bring it up one more time here. And again, like I said, we will provide you with this chart as a download. Finally, I want to recommend that you have a written plan. So if you're going to take this concept and run with it, you need to actually map it out for yourself. When you have a plan, this first year of being an attending, which is truly the time where most people get tripped up, is much easier to navigate. It is the most important year to decide whether you are going to be financially successful or not. It's a lot easier to grow into your attending income rather than to try to back out of it later. And this is your best chance for financial independence. So I want you to literally plan out each month of the year what you're going to do with those first 12 paychecks before you even get them, so that you're not tempted to do something else once they land into your bank account. If you can hit the ground running with a plan, I really think you're going to be set up much better for financial independence in the long run.
Thank you, Dr. Cicchetti. We want to reinforce some of the things that you've talked about. The first point that we need residents to grasp is a big paycheck does not guarantee wealth. You can make a lot of money, but it may simply mean nothing more than you spend a lot of money and you have a lot of stuff.
Yeah, according to Medscape, a doctor typically makes a 6-figure income. But to get wealth, it's about accumulating assets and eliminating debt. We have no picture. Wealth is net worth. And basically net worth, will teach you some financial terms, is if you add up all your assets, subtract all your liabilities, that will determine your net worth. Now, unfortunately, the majority of residents have either a zero or a negative net worth. Why?
Well, most of that has to do with their student debt, because their student debt is greater than the assets that they actually own. The general rule of thumb with student debt is to borrow no more than what you expect to make in your first year after graduation. But given the increased costs of medical school, this rule is often broken. The result is you can never have sufficient net worth to be financially independent.
Indeed, again, according to Medscape, surprisingly, 1 in 4 doctors age 60 to 64 do not have a net worth greater than $1 million. Therefore, they're likely not financially independent in retirement.
Yes, because according to accepted retirement income planning, think about this, a $1 million portfolio can only be drawn down at a rate of 4% per year to last through 30 years of retirement. Now that equates to $40,000 a year of withdrawals from a portfolio, and then whatever you're going to get from Social Security. This is not financial independence for a professional who's used to living on a 6-figure income.
So Rob, I have a question about that. I mean, to me, $1 or $2 million sounds like a lot of money to have put aside as my portfolio. And, I know doctors are accused of never thinking higher than $300,000. Like that's the limit of what we are able to comprehend in terms of financial numbers. But can you give me an idea? Like, let's say I plan on continuing to make $200,000 a year through most of my career. How much should I be putting aside if I want to live at the same level? Or, how do I calculate that?
If you were retiring today, Jillian, and you wanted to kind of maintain your standard of living at that $200,000 a year, you would probably need a portfolio, and I'm not including any net worth that you might, or equity that you might have in your house, but you ought to have retirement assets equal to about $4 million. And here's how the math works. Just take 4% of $4 million, that's $160,000 a year, then throw on some Social Security, there's your $200,000. So it was interesting when I first started dealing with all of these numbers, I thought $1 million was a lot of money. Now, this was back in the 70s. Interestingly enough, today, what you would need to buy what $1 million bought in the 1970s, you'd need a portfolio of around $5 million. Hopefully, that gives you an idea of where you need to go.
It does. Thank you. I agree with that idea of not being able to think much higher than 300,000. So I appreciate the perspective of the financial people. Thank you.
And so what happens, one of the reasons that doctors who are making good money, they end up in their 60s with only $1 million saved. Well, and Dr. Cicchetti touched on this previously, but it's of any combination of, if you have too much debt too soon and no plan to eliminate that debt, like your student debt, you drive an expensive car too soon, you have a mortgage that's 3 to 4 times your annual income, you have not made any provisions for emergencies. So if you have an emergency and you don't have the money set aside, you have to go out and borrow at a high interest rate. You put your kids in private school. Divorce, big one. Or you wait too long to get started on retirement savings. And we'll talk more about that in another session.
So the whole point of these presentations is to prevent this from happening to you. And in order to get you started, we want you to grasp what I describe as the unifying theory of personal financial independence. Now, financial independence requires that you move from being a highly paid doctor laborer to accumulating assets that'll work for you so you don't need to work. Yes, doctors are well-paid laborers. As a laborer, if you don't show up for surgery, if you stop seeing patients, if you reduce your shifts to your on-calls, you just don't get paid. On the other hand, if you accumulate assets that have the ability to produce income or withdrawals, you're not paid for the value of your labor. You're financially independent when other people pay you for the use of your money. Now, that could be interest paid on a bank account. It could be capital gains and dividends on stocks. It could be rental income from real estate. It could even be proceeds from the sale of a business. The next thing I want to provide you with is an important first step in financial independence is getting some outside help. So I want you to write down this website address, aamcfinancialwellness.com. You can go up here and you can register to have access to free resources that are designed specifically for doctors. This is a resource sponsored by the American Academy of Medical Colleges. It's completely free to you. Now, once you're in there, you can, and you're registered, I suggest that one of the first things you do is take the financial health checkup. That checkup is going to guide you to a series of online courses that you can view at your own speed on everything from checking your credit score to how to create a financial checklist to get started in investing. In addition to that, another excellent resource they have on the site is their MedLoans Organizer and Calculator. For a one-time fee of $10, you can get access to this, and it's a critical first step in developing a plan to retire student debt in 4 to 5 years. And on the subject of student debt, next step for you if you've got that debt, if you're going to pay anyone for financial advice and you have student loans, I suggest that you start with a student loan expert. You can check out Travis Hornsby's Student Loan Planner. A consult will cost you a one-time fee of $400 to $600, depending upon the size of your debt. At a minimum, go to Travis's website and subscribe to his newsletter and his free podcasts. Now, if you want to go deeper and educate yourself before talking with a student loan planner, you can download for free Dr. Ben White's premier book on medical student loans. You can get that on his website, or if you want to go to Amazon and pay $10, you can get it through Amazon. But write down these two web addresses. Accordingly, the first line of action for borrowers tackling their student loan debt is, what is the potential repayment strategy that you want to identify? What's the specific goal? Is it one, to pay off the loans as quickly as possible, as Paula talked about, and minimize the interest expense along the way? Or is it number two, to seek loan forgiveness and minimize your total payments along the way so that you can maximize the amount of forgiveness at the back end? Once your objective is clear, the planners can explore the best repayment options that are available to you. Another great resource for you, the single best internet resource for doctors, complete with a free newsletter and a 10-part financial boot camp, is the whitecoatinvestor.com. When you subscribe to Jim Daly's newsletter, you get all of this information for free. And I'm a regular listener to Jim's White Coat Investor podcast. This is an easy thing for you to tune in to. And when I work out, I just tune in to Jim Daly's podcast and listen to the questions that he's dealing with as a doctor, as well as the questions that are coming in from about 25,000 other physicians that are listening to his advice.
So once you have a plan to deal with your student loans and become more financially literate, it's time to start saving and investing. You should plan on saving 20% of your income.
20%, huh?
Yep, at least I save more.
I just like to spend, Paula. But yeah,
I save more.
20% is probably the right number. And to get started investing, as Dr. Cicchetti pointed out, if your employer is offering you a 401k or 403b plan and matching contributions in the retirement program, you want to be sure to contribute enough to pick up that free money. That's the first thing you want to do.
Okay, Dr. Cicchetti referenced this also, but it's worth saying many times so you get it. Eliminate any high interest debt. And the worst ones are credit cards. If you pay off credit card debt that you have, that's like getting an 18 to 22% return on your money, because that's the amount of interest you're paying on credit card debt.
So what we're talking about is save 20%, get your free match, eliminate high interest debt, then what? Now, the next thing is, you're a high income earner, you need to think about your taxes and reducing your taxes. And so that comes down to making maximum taxable deductible contributions to your retirement programs, your 401k or 403b. And once you're doing that, then you need to just eliminate any other debt that's out there and begin to move forward with what we've indicated here in terms of additional investing. In future webinars, we'll be discussing in more detail various kinds of financial priorities that Dr. Cicchetti presented earlier in this webcast. So look for webinars on the subjects of understanding risk and doctor money mistakes, a webinar on tax preference investing and retirement accounts, 401k, 403b, IRA, Roth, HSAs, and finally, how do you invest? Mutual funds, exchange traded funds, what is asset allocation? We look forward to your comments and questions. We thank you for allowing us the privilege of your time. Get started now on your journey to financial independence.
Thanks so much, Rob and Paula, for joining us. For all the residents and medical students out there, I really hope that what you got from our presentation today is that there is this amazing game with a really great payoff at the end, and every single one of you can win that game if you just follow the steps and have some discipline. So thank you so much for joining us, and we'll probably go on to answer some questions next. Okay, thank you.